There's a lot of chatter about a yield curve inversion, so what exactly is it? Well, the best way to explain a yield curve inversion is via an example. So let's just say you have a friend, and that friend is basically asking from you $5,000 and says that if you give him $5,000 for a period of 5 years, he'll give you a 5% rate of return. However, if you give him the money for just a year, he'll give you a 1% rate of return. Your natural reaction to this particular thing would be, well, that sort of makes sense because my friend is basically borrowing this money for a longer period of time, due to which I should receive a higher rate of return. However, what would happen if this whole fact pattern inverted itself? And he or she basically told you that if you give him the $5,000 for 1 year, he'll give you a 5% rate of return. And if you give him the money for 5 years, he'll only give you a 1% rate of return. In this particular fact pattern, you'll probably think that this whole thing is nonsensical. Now imagine if you were to zoom out a little bit and this friend is actually the Fed. And this is really what a yield curve inversion is. Basically, short-term borrowing rates are higher than long-term borrowing rates. So are we headed towards one of these? Well, if you look at this chart right here, it basically indicates that the 10-year and the 2-year treasuries are getting closer and closer together. With this chart, it is very apparent that the trend is not your friend in this regard. A yield curve inversion is very demonstrative of a policy mistake. So could this happen? Well, it certainly could, but it's also not the time to be risk-on. What's a risk-on asset? Well, think Cathie Wood. Now, personally, I think should there be a yield curve inversion, it'll be very short-term in nature. And the Fed will go into quantitative easing mode from quantitative tightening very rapidly. What are your thoughts? Include it in the comments, and this is not financial advice.